Check, 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 check. Yeah. Surprise, a little different than you used to. Yeah. Dropping these bars on YouTube, knowledge I introduce you. Yeah. We chasing this money like it's the prize, it's the voodoo. Fugazi, fugazi, it's just a lie we buying into. We need some cars on deck. Get the rollies, get the Moe, all the Mars on deck. All right, welcome everybody. Welcome to this live stream. I thought I would jump on because following the conversation we had the other day around Jeremy Hunt talking about the fact that he's quite happy for the Bank of England to continue pushing interest rates. There has been developments, obviously, in the mortgage market. Mortgage rates are being pulled. So I wanted to spend a little bit of time maybe talking about that and maybe take a few questions from you guys towards the end of this stream as well, because I think for most people who are first-time buyers, if you've got a mortgage, there are 1.4 million mortgages coming off their fixed rate pretty much from now on, and people are going to be shocked at the new interest rates that they're going to be offered. And so I think there's a lot of uncertainty, a lot of nervousness at the moment, and I just thought it would be useful to have a conversation, answer some questions, and just share what we know already about this new development that we've just found out about from about yesterday. Really, this started to hit the news. And so what I'm going to do is let's just go through an article actually on BBC because it is the article itself that kind of gives us a breakdown of what's going on. Hopefully you can hear this. So if not, please do let me know in the chat if you can't. Right now, nearly 10% of UK mortgage deals have been taken off the market since last week amid concerns about how high interest rates will go, figures show. Financial data firm Moneyfacts said nearly 800 residential and buy-to-let deals have been pulled as lenders are reassessing their offers. Meanwhile, average rates on 2-year and 5-year fixed rate deals have also risen. It comes after higher than expected inflation figures raised forecasts of how much UK interest rates will go up. Now, interestingly, let me just share this tab with you as well. So I use this all the time just to have a look at the forecast for the economy and where we are at any given time. And if you've been following the news and been following the forecast, this is where we are at the minute. When we're already in Q2, second half of the year, Q2 right now, this is what the forecast should be, but this is where we are. And even though we have seen this number come down from 8.7%, come down to 8.7% from 10.1%, it's still below the forecast. And so from the conversations that I think we're seeing and hearing from Jeremy Hunt in the comments that he made last week is that he is going to fully support the Bank of England pushing interest rates even higher. And this is really what's caused 800 residential and buy-to-let mortgage offers to be pulled from the markets, because there is just so much uncertainty around the moment around what rates are going to be available to lenders, which then need to be passed on to us mortgage holders. And look, it's one of the situations where if you weren't already stressed out, you're probably a little bit more stressed out now. But this is where we know, or at least this is what was discussed or forecast or at least signposted last week. The current bank rate is currently at 4.5%, as you can see right here. It was actually projected to be higher, 4.75. But the conversations being had at the moment is that the bank rate will go to 5.5%. 5.5%. So we'll see another bank rise fairly shortly. And then after that, we're going to see another one, which will push it up to 5.5%. And this is what's causing a lot of stress. And all you need to do is just have a look at the graph here on this. Let me just share this one right here. This is the graph now of looking at how mortgage rates have actually changed. So when you look at, December 21, 22, October 22, 22 to where we are right now, they're getting there. I mean, obviously we had the quasi-quartan um, budget and stuff like that last year, which kind of moved things. But this is where we're going to be at the moment. We're going to be looking at much higher interest rates moving forward. And I do think it's worthwhile, because I did kind of cover this in the last live that I did. And if you've not watched that, maybe it's worthwhile going back to watch that. I did talk a little bit about interest rates, and I showed you a graph, which I'm just going to try and find now, which basically, let me just share this tab, which look back at interest rates back in the 1970s and 1980s. And as you can actually, I've not selected the right. Let's go max here. There we go. So look at these interest rates. This is back in the 80s, right? You're looking at over 15% interest rates compared to where we are right now. We're in relatively still low interest rate environment compared to the peaks here, and maybe even the peaks here through the early 1990s. It's a far way off. And so a lot of people are still wondering whether we're going to see the bank rate come down and mortgage rates come down as a result of it. And I just don't think that's going to be something that we're going to see again, not for a very, very long time. And I was speaking to someone earlier today who messaged me on Instagram. They're looking at remortgaging at the moment, and they already have an offer on the table to basically see if they can get into a fixed rate. And I think they were being offered something like 4.64% at this point in time. Now, obviously, your mortgage rates that you're offered are heavily dependent on your loan to value. So, how much is your house worth versus the mortgage you have against the property? So, for people with low loan to values, they get offered better rates. So, they'll likely get 2 or 3% offers, because there isn't as much risk in the deal for the mortgage providers, the banks, as if you had a mortgage where you're still at that 80%, 90%, 95% loan to value. You're really going to get stung at that point. And so I think that, given everything that we know at this point in time, we're in for a bumpy ride. And, let me just bring this screen back up again, just to kind of go back out again, because I think if we're being optimistic and we look at the forecast for interest rates, this is where they're thinking it should be. They're saying 4.5% by Q4 2023, which is where we're at currently. But this is heavily going to be dependent on the inflation forecast right here. So we already know we're behind the forecast of where we should be right now. Q4, we're hoping for it to be 3.9 to just below 4%. A lot needs to go right between now and then. Now, wholesale energy prices have been falling, so we're going to start seeing that come through in the inflation number fairly shortly. So hopefully what we'll see is another reduction in the inflation number at the next take. But to be honest, I'm not really too sure what's going to happen, if I'm completely honest. And I don't think anybody has the ability to be able to forecast and tell you what is going to happen. I think anyone who can say or tries to make out that they know with any certainty as to what's going to happen, I think they're just lying through their teeth. I think we need to be prepared for the unexpected, and that is being pretty honest. If I'm honest, because nobody knows what is going to happen from here on out. God forbid we see another spike in inflation in the next month and a half. The Bank of England will just keep going, which means that we're going to see the interest rates move even higher. But what I think is happening at this point in time, and this is just me and it's my opinion on it, and I could be wrong. Don't get me wrong, I could be 100% wrong. But what I think is happening at the moment is, because we've had this supposed win, inflation down from 10.1 to 8.7%, I think what they're trying to do is take the initiative and basically go for another rate hike with the Bank of England, with the aim of pushing the inflation number down as far as it can go, or at least match the Q2 target of 7.5%. If that happens, they may ease off. If it doesn't, I think they'll keep going. And so ultimately, just be prepared. Be prepared for the unexpected. And I know that earlier in April, the forecast was that mortgage rates were going to be much, much lower. 3.5% is what was being mooted at that point in time. But things change. And when they're making these kind of decisions, it is based on, obviously, what's happening at any given time in the economy, looking at all of the numbers, the inflation numbers, and so on and so forth. And will this push us into a recession? I spoke about this last week on the last live. There is a chance that it will. I mean, because even when you start looking at some of the forecasts for our GDP, I mean, look at our GDP at the moment. It's pretty pathetic, right? Look at this, that line right there. I mean, our actual GDP performance at the moment is 0.1%, you know, and that's what we're dealing with. And the irony is, in order for us to avoid a recession, we need these GDP numbers to be much, much higher. And this is where, you know, policy comes into play. What are they going to be able to do as a government to be able to, you know, push up employment, um, incentivize businesses to invest, make the economy a favorable place for for companies to want to invest in? I think a lot of the calls that they've made around, you know, corporation tax and the brackets there have kind of put off companies, and I think we're going to start seeing this come through in our GDP numbers. But at the end of the day, this is what we're playing with. And you know, if you look at the likes of the states, I don't even know what the forecast for the states is at the moment. Let's actually just have a look at that. You know, GDP forecast for the states at this point in time. Where are we? Let's have a look. GDP. I mean, look, they're in the 1% at this point in time. In previous 0.9%, but when you go back to ours, we're it's pretty dire. I mean, we're on the cusp of negative territory, and the danger is that with further interest rate hikes, that will push us into the negative territory. And Jeremy Hunt has been very, very clear last week in the response to to the question put to him that would he still support the Bank of England if it meant would hit a recession. It was an unequivocal yes. So there's a lot of uncertainty. There's a lot of, I guess, people going to be worried. I mean, if you're on a mortgage at the moment, or you're coming off a fixed rate like I am in October. I mean, my plans have completely changed. The way I'm viewing this now is completely different to the way I was looking at it maybe 3 to 4 months ago. Now I'm seriously considering actually paying off a large chunk of my mortgage. And in conversations, I've actually just realized by reviewing some of my finances and some of the things that are actually happening, I could be mortgage free in 2 years. And that's playing a big part in my decision right now. And how that changes for me is that there will be less money going into the market, but the freedom of knowing that I could be mortgage free in 2 years' time is actually quite attractive. It means that I could probably invest a little bit more aggressively. And this is why I really do want to talk to you guys on a very kind of like, you know, on an honest kind of level, really. The decisions in these times are very, very difficult. Like, what do you do? It's very, very easy to, you know, ponder whether or not interest rates will continue to reduce or whether they'll remain the same. Should you wait? Should you not? Should you go into a tracker just in case they do change? I just think that given everything that we're seeing, I don't think that interest rates are going to come down to previous lows. And I think you need to be aware of that if you are trying to decide what it is you're going to be doing now. It's not for me to tell you what to do, but I'll repeat what I've said on a number of other lives, and that is try to make a decision that gives you the best control over your circumstances. For a lot of people, they're able to make financial plans and plan ahead a lot better if they know what their monthly expenses are going to be. I literally know someone who was seeing their mortgage increase significantly. And I'm talking, we've had what, 13, 14, 13, I think it is now, 13 Bank of England base rate increases. On a standard variable rate, 13 increases. Her mortgage increased a lot. And they're looking to get fixed now because just dealing with the uncertainty, look, it's stressful. I mean, I can't even begin to even fathom how stressful that must be. And if you're going from, you know, a 1 point something fixed rate, you know, to what will be probably a 4-5% fixed rate this year, it's a big, big shock to the system. And the only thing I can say is what I've just said: try to make a decision that's going to put you in the best control of your personal finances. Because if you're already squeezed and this will squeeze you, this really, really will squeeze you. You want to make sure that you've got everything accounted for and you don't put yourself under unnecessary pressure by going on to a tracker or a standard variable rate just because you're hoping that interest rates will go down. I could be wrong in this, and interest rates may come back down. The reality is we just don't know. So I think you'll be better prepared if you plan for the worst and hope for the best, and go from there. Whether you fix for 2 years or 5 years, because of my personal situation, I mean, my original view of this was that I was going to fix for 5 years. Now that I've had a look at my finances and thought about how I might be able to restructure things, I'm quite tempted to now go for something like a 2 year fix, because if I can be mortgage free in 2 years' time, I don't want to lock into a 5 year fixed rate, which will mean that I've got to pay early repayment charges to clear the mortgage. So you've got to make the decisions that are going to be best for you and your circumstances. And watching this live and interacting with the channel in the way that you do isn't necessarily going to give you the insight, but I share how I'm thinking so that you can kind of take that into context for your own decision making. But I hope this is helpful. I'm just going to pivot and move one of my screens over here. Let's just see what everyone's saying in the chat. Let's get to some comments here. Good afternoon, Daniel. How you doing? Daniel's saying, "What an intro!" I'll tell you a little secret. I used to do music many, 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 many years ago, and the intro that you just heard is a track that I recorded with my friend who I started music with, and we were just having a little bit of fun, and it's been sat in my folder on my drive for like a year and a bit now. And because I'm trying to up the live streams, and we're going to be doing way more live streams on the channel because it's all about conversations, I thought I'd pour that out the bag. It is a full track. Well, it's not a full track, but it was just a little bit of fun. I was going to do something with it, then I decided I wasn't going to do something with it. But hey, if it gets used here, then that's cool. But yeah, thanks. If you liked it, fantastic. That's good news for me. That's really, really good feedback. Let's have a look at your comment here. This is honestly sounds like 2008 all over again. 100% mortgages, fixed rates going out the window. But if you continue waiting for a crash, it may never happen. Time in the market versus time in the market, 100%. On that, I think we're at a different place to where we were in 2007. If you think about what happened in 2007, it was because of the subprime mortgage market. And a lot of these companies that found themselves exposed didn't have the level of liquidity that was required to cover those kind of positions that they ended up taking, particularly when you start getting into this synthetic credit default swaps and the madness that happened there. I mean, how this stuff happens is just ludicrous. And the funny thing is, even though this all came to light, they just sell the same thing packaged as something else. So I think we are in a different place purely because the regulators have now made sure that all of the financial institutions need to have enough liquidity, so money set aside for their potential liabilities. That didn't exist in 2007. But with that being said, there are some similarities. I mean, yeah, 100% mortgages. Look, if you look at the Skipton Building Society offering for that 100% mortgage, if you really look at it, the people that is going to help in terms of the people that will be in the catchment to benefit from that are going to be minuscule, because of the way they've kind of structured it, right? It's going to be minuscule to say the least, because by my calculation, you would still need to be on about maybe £175,000 or £200,000 a year to be able to qualify for that 100% mortgage that Skipton put out maybe 3-4 weeks ago. It's that high. And so what they're doing, and that's intentional, 100% is intentional, because as a mortgage lender, what they're trying to do is they're trying to manage their risk. And by going for high earners, they reduce that risk even more, because you would hope at that level there's more disposable income, there's probably a bit of a nest egg in terms of savings going on in the background, there's hopefully a little bit more financial security. That isn't the case all the time, because I know people who earn serious money and are still broke, and they're leveraged up to the tits on credit cards and overdrafts and mortgages and all sorts, you think that they will be better with their money, but that's not always the case. So there are definitely some similarities with interest rates and 100% mortgages. I would agree with you on that one, mate. Let's have a look. Someone just saying here, I'll say that will be 5% by end of Q4. I wouldn't be surprised at all, mate. I think some of the 2-year fixed rates are closing in on 5% anyway. If you look at different loan to values, it's going to start to bite when you get to the point where the lower loan to values start getting to those high rates. That's where it's really going to bite for people. Let's have a look at what Ezekiel's saying here. Good evening and welcome, welcome, welcome. Thanks for joining. Let's have a look at this comment here. It's only a start, and a lot of people are going to have a shock to their lives. Sad, but it's coming. There will be losers and there will be winners. There will be both losers and winners, 100% for sure. And I did a video yesterday talking about investing. I was looking at the UK specifically, and if you think about the UK and the FTSE 250, there are some very, very good, well-priced companies that are cheap at the moment in comparison to where they were maybe even 5 years ago. And that's an opportunity, and that's potentially where a lot of people are going to win in the investing arena, looking at the markets as a whole. I mean, the states at the moment, in the 11th hour, leaving it till late to agree a new ceiling to their debt, increase their debt ceiling. I mean, I've never known it to go this late. And you can bet on one thing: the Americans are never going to allow themselves to go into default because of the knock-on effect globally and the damage it's going to do to them as an economy. But they left it right to the last minute, and it was quite surprising to see that they've left it that late. And that is just testament to the fact that it feels as though there's the states is very fractious right now. I was speaking to an American last week, and they were saying the country is very divided right now, especially across the political divide, and that in itself is a bit of a worry for the markets. But you're right, there will be winners and there will be losers. Someone just asking here, do you think property prices in London will continue to fall? I think potentially yes. I mean, within London, though, there is the basic supply versus demand equation, right? And I think you will see property prices fall, but I don't think that it will fall as much as other places outside of London. I think the London market is relatively resilient. That's what I think. But any help for first-time buyers at the moment will be a good thing, particularly in London, because property prices are pretty nuts. They're absolutely crazy. Let's have a look at this one here. Pete, I said to you previously on a live that if the truth be known, we are already in a recession and nothing has occurred in the last couple of weeks has changed that opinion. Mate, you could be right. You could be right. I mean, the numbers pretty much put us on the cusp of it. I mean, teetering over. I mean, I think as well, there is manipulation in the numbers. I mean, you think about the inflation number and all that kind of stuff, and they put out this is the rate of inflation currently. Well, that number can be tampered with because they're using a basket of goods, and they could just swap out what they put in that basket to make the number look a little bit better. And a lot of this stuff is about perception, public sentiment, confidence in the markets. So I wouldn't necessarily disagree with you at all, mate, on that one. Where am I? I've just lost my place. Oh, here we are. Here we are. Okay. Naomi's just saying, thanks for teaching. Thank you so much for watching, Peter. Good evening, Pete. I've just read your book and loved doing my essentials, non-essentials, and other planning. Do you think it's best to fix for 3 years instead of 5 at current rates? Mate, thank you so much for picking up the book, mate, really. And if you've completed the book as well, fantastic. Thank you. The book has done really, really well, and I like getting messages like this because it was stressful writing. It was stressful to write. I can't even tell you how stressful it was to write. And so hearing people getting positive outputs from the book is music to my ears. It really, really is. Thank you. Do I think that you should go for a 3-year fixed rate, a 3-year fixed rate over a 5? Really down to your circumstances, mate. Like I've already said, I'm probably going to go for a 2 year fixed rate now because looking at my finances, it wasn't the plan originally, but I think in 2 years' time, being mortgage free is probably the best thing because it will allow me to do away with that, allow me to restructure actually my life, generally speaking. I may, and I say this with a pinch of salt because I know what I'm like. I'm a workaholic. I have to be working. So I say this now that it may mean or allow me to not work as much, but I know deep down I probably will continue to work as much. But what that will do is it will allow me to plow money into investments even further and build my investment portfolio to a much larger amount by a much quicker rate at a much quicker rate than previously. So that's what I'm going to be doing. I think you need to have a look at it, a look at the circumstances from your personal standpoint and decide which will be best. If there are certain things that are going to be happening, in the next 4 years, that means that a 3 year fixed rate would be better than a 5 year. Maybe again, paying off a chunk, or you need to plan for something in 3 years versus, and that's a better choice versus a 5 year, then that's what you should do. But if you've done the essentials, non-essentials, and the other, you'll have a really good idea from your budget what you're planning towards, what your goals are. Because remember, the other part is all about future aspirations. So if it ties in with your budgeting plan from the book, then by all means. But if you're still kind of umming and ahhing, maybe revisit. If you don't know whether you did exercise one, task one, that wheel of life, the exercise where you prioritize a number of facets of your life and then you score them and you pick out the ones that are most important to you. This would be a really good exercise perhaps to revisit for this decision, because if anything that you scored in that wheel, and you put a timeline to it, like in the timeline planning exercise, if that coincides with 5 years or 3 years, that should give you the answer to the question, really. So maybe go over those exercises and revisit that as well. Videos to view, how you doing, mate? Welcome, welcome, welcome. Ah, yes, Sprite. Sprite is amazing, by the way. I had what's his name? Vinesh. I want to say Vinesh. He was on the podcast last year. Beginning of last year, I think it was. I should actually get him on. Actually, to be fair, I should try and get him on a live stream. I'm going to reach out to him actually, because so Sprite is an app that allows you to basically work out how quickly you can pay off your mortgage, and by making overpayments, it works out what that looks like. It's a brilliant, brilliant app. Is it Janesh or Vinesh? Janesh. It's Janesh or Vinesh. I'm going to reach out to him and see if I can get him on a live stream actually, and we can talk about the app and maybe do a. I don't know if we can do a demo, but maybe we can just talk about the app and highlight some of those things, because I think that will be really, really useful in a time like this. But this is a really good shout, Daniel. Thanks for that. Actually, I'm going to write that down a bit later on, to reach out to him and get him on the show. Um, Someone thoughts on the pocket home scheme. Uh, where it's buy at 20%, but then have to sell. So it's just renting by the back door. I've not heard of that scheme, mate. I can have a look into it, but I've not heard of that scheme. Um, I can't really comment, mate, unfortunately. Sorry, Pete. Random question. What did you use to write and publish your book? So I'm published with HarperCollins. So to write it, I used I don't know if I've still got it on here actually. Have I still got it on here? I What was it called? There's a piece of software that you can use to basically help you plan and outline your book. And I used a piece of software for that because when you export it as well, it puts it in the format that most publishers actually want. So if you send it in a Word doc, it's just messy because they've got to then format it. I mean, they have to do formatting anyway, but this piece of software actually helps with getting it to the publisher in a nice format. So when they're formatting it, most of it's already done. I can't remember what it's called now. It's not Scribble. Um, I can't remember what it's called now. If I remember, I'll put it in the comments, Daniel. But yeah, I'm published with HarperCollins, so they offered a lot of help in helping me actually get it written. In terms of my editor was amazing, a lady called Rose Sandy. She was incredible. She was really, really cool because I'd never written a book before. So she was there in terms of guidance and just helping you get everything out of here into a structure that you work through. She was amazing, and I wouldn't have been able to do it with her. But thankfully, I only got that support because I was with a major publisher with HarperCollins. So yeah. Let's have a look. Someone's just saying here, Ezekiel, I agree that the powers that be have been massaging the figures regarding cost of living, etc. One thing we can deduce for certain is that in terms of retail, people are not spending. Yeah, I've not had a look at the retail numbers just yet, actually, but I think when you start looking at, if I just finished shooting a video which is about investing in a recession, that's going to be out in a couple of weeks' time, and I was looking at the retail spaces and how many stores have announced job cuts where they're letting people go this year. And on in the piece, the article that I found, there were like 10. And this is like 500 jobs, 800 jobs, 100 jobs, 200 jobs. There's quite a lot of jobs already going in that retail space because in a recession, that's one of the first things that people stop doing. They stop spending money on unnecessary stuff. And I don't want to give away the premises of that video, but I talk about, the basics around investing. And there has never been a better time to remind ourselves of those basics than a time like now. It's all about investing in companies that are integral to the way that we live our lives and produce products and services to make that happen. And over the past maybe 2 or 3 years, I think that basic understanding's kind of gone out the window because it's been sexy and goldfish could have made money in the markets in 2021, right? And that's just a fact. Anyone could have made money. You didn't have to be necessarily experienced. You could have just put money in, you would have done fine. When recessions come along, that's where people start to get a little bit worried. And that's where you need to kind of understand the foundations, the basics of what investing is all about, so that you can make the best moves and not necessarily go gun ho, but also see a recession for what it is. Yes, there's an increased risk, especially when you're investing, but there's also an opportunity, and it's all about understanding how to take advantage of that opportunity in the safest way possible, whilst taking the right amount of risk for you. So I'll agree with you a bit on that for sure. You know what, Pete? This is a really, really good question because I did a video and I ran a poll. This is maybe like a year and a half ago. I asked people about 25, 30-year, 40-year mortgages, and everyone was like, I'll be dead by then. And I think people kind of didn't necessarily or didn't necessarily get what I was getting at, because what's the average term of a mortgage right now? The average term of a mortgage is 35, 40 years for a normal person, right? And in the States, they're used to locking into 10-year fixed rate mortgages. But in the UK, because, and I need to bring this back up again because it's so fascinating when you watch it, right? And you see this, right? So let me just go back onto the interest rates. Now I need to find the right window. Where is it? Let's go back onto the interest rate curves here, right? And let's go max, because this paints the picture beautifully. So if you go back in history, 1970s, the interest rates are all the way up here. That was the peak. So as a nation, what's happened is we've become used to the idea that the only way rates can go is down. And that's what's happened to interest rates over the long term up until now. They've gone down. Now, in the States, they'll happily lock into a 10-year, 15-year fixed mortgage into a fixed rate because, well, you're guaranteeing that your payments are not going to go up for 10 to 15 years. Now, it might not be the best rate on the market, but what it does do, it gives you a pretty nice environment to be able to plan your income and your expenditure, your budgeting from a place of knowing. For the next 10 years, my mortgage payments are going to be this. In the UK, we've enjoyed this downward trajectory in interest rates for a very, very long time. There was no place for interest rates to go apart from down. Since 2009, we've been on the floor. And that's where people have enjoyed, 1% mortgages. I think my mortgage coming off its fixed rate at 1.49%. I mean, can you believe it? 1.49%. We'll look back at this in history and think, what on earth was going on back then, right? Like this will be unprecedented when we go back in history in 20 odd years time. So now we're at this point, and now we're starting to think, well, actually, if we could get fixed into maybe a 10-year fixed rate mortgage at 4%, maybe that doesn't sound like a bad deal. So I think that ultimately, when you look at interest rates and you look at the ability for people to lock in their their mortgage payment for the long term, I think that's going to become even more attractive depending on what happens with interest rates moving up. I mean, God forbid, we get back to this kind of territory where you're in the double digits. God forbid. But we don't know what's going to happen. Hopefully, that's something that will never happen again, but stranger things will happen. I bet if you went back to this period of time here and you said to them back then, yeah, in about, 30 odd years time, we're going to have mortgage rates at 1.49 and the Bank of England base rate is going to be at like 0.1%. They would have been like, never going to happen, but it did. So we don't know what's going to happen. So I think personally that longer term mortgages are going to become more attractive as we as this kind of evolves and depending on what happens moving forward. So really good question there, Pete. Um, let's have a look. I've just lost where I was because I had to go onto another tab here. Um, there we go. Ah, yes, yes, yes. Yeah, I had a chat with you on the gram about social media views of not buying a house and investing in other revenues. I find it's crazy views, but each to their own. I personally think a house is security. I do remember the comment now, mate. And I think this is worthwhile talking about because whilst many people will say it's it's too much hard work, it's too difficult to get on the property ladder. I come at this from the point of view of someone who's worked in the industry for some time. And when I work with people, when I used to work with people as a financial advisor, and I do now as a coach as well, when we start looking at, forward planning their finances for retirement and looking at later life, oftentimes people's homes are their biggest asset. And so not buying a property pretty much derides you of the ability to release equity or use the asset for future income later on. If you think about it, most people have families buy a 4 or 5 bedroom house, 3 bedroom house. But when the kids have left home and you're looking to slow the pace down slightly, you're not going to need, a 3, 4, 5 bedroom home. So you may decide to downsize. And in downsizing, if you own that property outright, you're releasing cash which can be used for income to help you live. And I think if you don't get on the property ladder, you potentially rob yourself of that ability. But at the same time, I can also see where people would say, actually, I don't want to get on the property ladder. And the reasons that they will give you is because it's too expensive to maintain a home. Yes, it can be expensive, but what asset or what thing do you ever own that doesn't cost you money? Most people will go and blow 100 grand on a car, 50 grand, 40 grand on a car, which they're constantly pumping money into in fuel, constantly changing tires on, constantly paying for MOTs and AdBlue and all sorts of stuff. Those are the same people who will say, don't worry about property. And I think that narrative can be dangerous. And I'll say what I said to you. I think you need to look at it based on your own personal circumstances, how you see your life panning out, and making the decision based on that and ignoring some of the noise that you're hearing on social media. There'll be plenty of people who would disagree with what I've just said there, and that's completely fine. And I think it's okay to disagree. And really, we should encourage this kind of discussion because there are merits to different arguments, right? And ultimately, by having this discourse, you give people the tool to be able to make their own decisions. And that's what really matters. It's not forcing your opinion on somebody and saying, this is what I think, so this is what's right. It's not right. That's not the case. Personal finance is personal. So you have to make the decision that is best for you. And I wholeheartedly believe that. There we go. Greg, it's like you read my mind. Scrivener. It was Scrivener that I used. Cheers, Greg. Absolute legend. It was Scrivener that I used to a software piece that I used to write the book. It was great. Thanks for that, mate. I don't know why I was thinking. I was thinking Scribbler or something like that, Scriber or something. I was thinking. Good man. Alex is just saying here, last year I made an offer with a 2% mortgage rate, which unfortunately fell through. Today I was contacted and I was asked if I'm still interested. However, mortgage rates is 4.2%. Shall I make a lower offer? Look, if you're talking about offering for the house price, I think that you've got nothing to lose if you do. Nothing to lose at all. Because one thing that will definitely be on the card now is that because we're seeing interest rates increase, this becomes so much more unattractive a proposition for landlords. And a lot of them are kind of thinking, I'm probably just going to cash out. And so you have the opportunity. If you're a buyer right now, I would say probably you have the momentum on your side, potentially. So going in with a lower offer to purchase a place, 100%. You should definitely do that. If you don't ask, you don't get at the end of the day, right? So, and you never know what that might lead to. Whew. Samantha's just saying here, we are going to 6% and probably 7% by 2024. Whew. I hope not. I really, really hope not, because that would be really, really painful. And that would really put the squeeze on people. I mean, for first time buyers, I mean, Jesus, makes it nigh enough impossible. And first time buyers, because this is the crazy equation, right? House prices may fall, interest rates go up, and therefore the banks and the lenders tighten their affordability criteria, which makes it even harder for first time buyers. And whilst the deposit will be less because the prices have fallen, that side of the mortgage application and the mortgage criteria will basically work against them. And whilst you're going for, a property where you might still be looking at 90% loan to value, oh, really, 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 really painful in terms of the mortgage payment. So that will only make it more impossible for first time buyers. And that's not a good thing. It's really not a good thing. So I hope this prediction is wrong, but who knows? We'll have to wait and see, right? Given investing is a long-term 5 to 10 years, you should overcome any dips in the market caused by the recession if you understand it right, mate. That's very, very true. But again, this is one of the things that you can't control. Point of entry does play a part. So, and this is why sometimes in a recession, it's such a good opportunity, because if you get in at what you think might be a low in the recession, and there is no way you can predict this, riding the wave up is always good. But the last thing you want is, and I have seen this happen to people where they've invested whilst the markets are up, the markets have done really, really well, and the end of their investment term, that 5 year or that 10 year point or somewhere in between, sits right bang in the middle of a recession. And because they invested at a high point, they're now down here. Becomes really, really difficult a decision to make around whether or not you're cashing your investment for the purposes you were investing for, or simply just hold the bag and keep on stay invested in the markets to ride it out, which could then take another 5 to 10 years. So this is why in my book I talk about the fact that it's really, really important to have things like, your emergency fund. And that's in the save early part of the book, where I talk about, yes, get the emergency fund, then obviously you can then start to invest knowing that you're not going to need the money. And it's all about getting the balance between what you're investing and what you're holding back to be able to compensate for scenarios just like that one. I mean, it's so multifaceted, and it's hard to know exactly what to do in the moment, because to be honest, when you sit down with someone and talk to someone about it, an outside person is often able to give you a unique perspective, an outsider's perspective. When it's your money, you're invested, and the markets are down, it's so hard to make rational decisions in the moment, because the thing that you're thinking about is the loss. The markets are down. So, how do I protect myself? And that's where sometimes financial advisors do a great job, being that outside person. I try to do a little bit of that now as a coach, but I'm limited on what I can do because I can't give advice. I can only coach people and help people see perspective. But yeah, it's a really tricky balance to be able to make, and that's why your goals and your objectives are so important. And more importantly, you have to review. You have to review where you are at any given time on a consistent basis, as well on the journey. Samantha's saying here we're not going low again. I think you're right. Um, because you're saying a house, 100% agree. I think you're renting what's cheaper. I would be attracted. It would be attractive. I might be basic, but I like the idea of owning. And that's another point. Actually, I do need to speak to someone. I've been trying to get someone on from Rightmove to talk about the the things that they're noticing when it comes to house prices and renting, because rents are going up dramatically, and the simple fact still remains that getting a mortgage, having a mortgage is oftentimes cheaper than rent, and that's always been the case for a very long time now. But I'm just going to scan very quickly because I'm just mindful of how long we've spent here. It's about 45 minutes already, and I thought this was going to be a quick one. Thank you so much all for the comments. I really do appreciate it. Um, I'm just scanning here. Yeah, Anil's just saying here that wages did not keep up with inflation. We're all just getting poorer. By investing, we at least have a chance to maintain or grow our money. That's very, very true. I mean, one of the main reasons why you should start investing in the first place is because it's one of the primary ways to actually beat inflation, particularly now with inflation being really, really high at 8.7%. The need to invest, or the argument to invest, becomes even stronger. And hopefully this is where channels like mine will educate people, give people the tools that they need to be able to do this the right way, and not feed into a lot of the hyperbole that's been very, very common here on YouTube. And it's very, very frustrating to watch sometimes, but at the same time, it kind of, I wouldn't say it's nice to see that the hype has kind of died down, because I know that there'll be a lot of people who invested thinking, hey, this is going to be great, and now looking at their portfolios in the minus and thinking, "Oh my God, what do I do?" Um, but I think it is kind of like it's definitely a learning point. It's something definitely to learn from. So, look, guys, thank you so much for attending this, and being here with me and commenting and putting all of your questions in here. I hope you found this useful. We will be doing more live streams like this one, on the channel. I'm thinking maybe covering a little bit more news and trying to make sense of that. Um, Please, if you do find value in this, make sure that you smash the like button. If you're new, you haven't subscribed to the channel, this is the kind of stuff that I do here. I try to talk about this stuff in a conversational manner, try and keep it really, really simple, easy to understand. And I do not do any of the hype. So I'm not the kind of channel. So if you've not subscribed already, please feel free to subscribe. I thank you so much for your attendance and for your attention. I know that it means a lot. It really, really does, especially to spend 48 minutes with me on the channel. So thank you so much, guys, and I will speak to you soon. Catch you in a bit. Cheers.